Hey everyone, so as an actuary and an investment researcher, I've always been fascinated by the different investment strategies that are out there. So join me because in this video, I'm going to run through my top 3 elements of value investing, which is the strategy that Warren Buffett used to generate his fortune. Element number 1 is do fundamental analysis. So value investing was made famous by Benjamin Graham, who wrote this book called The Intelligent Investor in 1949, so a long time ago. Benjamin Graham was a mentor to Warren Buffett and obviously taught him the art of value investing. So value investing primarily involves doing fundamental analysis on the company. So that means looking at the company's financial statements, its income statement, its balance sheet, and trying to understand if that company is a solid company, i.e. one that's going to stand the test of time, or if it's one that could potentially fail or blow up at any moment. By looking at the fundamentals of the company, the aim is to determine its intrinsic value, so what its rational price should be, and that's typically a function of the dividends that it's expected to pay out over the lifetime of the company, also the growth in those dividends or earnings growth over that lifetime as well. And that is what we call fundamental analysis. Personally, I don't do this type of investing because it's incredibly time consuming to do that much analysis on the company, and I have no real edge in it, so I don't think it'd be very good at it, and I'd have to practice a lot. So Warren Buffett was famously obsessed with fundamental analysis, so going through companies' balance sheets, and he's been doing this for absolute years, and he's arguably the best in the world at it. So that's what it takes to be Warren Buffett and to have his kind of investment performance and that kind of longevity in his investment performance. However, if you wanted to get started, I read a book called Rule Number 1 by Phil Town, and he talks through quite a simplistic way of doing some fundamental analysis on companies. So by focusing on a few different metrics and using ways to triage the investment universe by focusing on companies that you might have an affinity towards, he comes up with quite a convenient way of how to do some basic fundamental analysis and hence value. I do think it could be quite fun picking companies like this and seeing how they perform, but it's just not something I have time for right now, so it's not for me, the fundamental analysis side of things. However, don't let me stop you. So element number 2 is to buy that company at a discount. So once you've done your fundamental analysis and you come up with your intrinsic value of that company, you then go into the market and you see how the market is pricing that company. And if price is well below the intrinsic value that you've calculated, then you're going to get yourself a bargain. So you should buy that company. However, if the company is trading way above that intrinsic value, then you should wait and you shouldn't buy at that inflated price. Warren Buffett talks about having a kind of moat around his investments, meaning that he's buying at such low prices that there's kind of a lot of room for error, meaning that he's less likely to make a mistake. So this is based on the premise that the market is irrational, essentially. And the way Benjamin Graham describes it is he calls it Mr. Market, who's a manic depressive, and sometimes he shouts out prices that are really high and sometimes he shouts out prices that are really low. He very rarely shouts out the price that the company is actually worth. So what you've got to do as a value investor is wait until the price is well below your calculated value, make sure there's a significant moat or margin of safety, and then you invest. Interestingly, this conflicts with one of the core tenets of investment theory, or that we're taught in our professional qualifications, or that we're taught at university, and that is a theory called efficient market hypothesis. And the efficient market hypothesis states that prices reflect all current available information available to investors at that one point in time. That basically means that the market is completely efficient and the market is never mispricing a company, therefore you can never pick up a bargain. And I think Mr. Buffett has proved the efficient market hypothesis doesn't hold, at least in its strong form, because he's been able to outperform the market in this way. The reason why people use the strong form of the efficient market hypothesis is because you can do lots of interesting kind of theory and calculations if you assume it holds. Indeed, it does hold in some respect. Prices change as new information comes out. It is quite hard to beat the market, so it holds on the whole, but you definitely can find instances where it doesn't. If you'd like to learn more about the efficient market hypothesis, I'd recommend the book A Random Walk Down Wall Street by Burton Malkeil, and he still supports it, even though it's in its 8th edition or something. But yeah, you can learn more about the efficient market hypothesis and the rationale behind that from that book. I don't necessarily believe in the strong form of the efficient market hypothesis. I think from my experience, I've seen lots of instances where it doesn't hold. I believe that in general, markets tend to overreact to positive and negative news, which means there are definitely opportunities to buy bargains. However, you have to be patient because these opportunities don't come along very often. So yeah, I definitely think that the market is irrational at times and it doesn't accurately price the intrinsic value of the securities in the market. I think this is largely backed up by Thinking Fast and Slow, the book by Daniel Kahneman and Amos Tversky, who talks about all the issues that humans have with making rational decisions. When you model the financial market as a complex adaptive system made up of individuals like you and me making those irrational decisions, it all kind of makes sense. And actually, if you want to dig more into kind of how value investing interacts with complex adaptive systems and that model of markets, there's a great book called The Education of a Value Investor by Spier, and he talks about how these kind of biological models are actually a much better model of financial markets, or at least the economy, because they better explain how things actually work. So yes, buy your companies at a discount. So element number 3 of this strategy is you have to be a very long-term investor. So because markets are irrational and prices can deviate very far from the supposed intrinsic value, you could be waiting a long time for the markets to rationalize and for you to realize the value in your investments. On the flip side as well, you could be waiting a long time for the market to be pricing in a bargain. Stock market crashes and big price falls are actually quite rare compared to market rallies. And they tend to happen quickly and suddenly rather than market rallies kind of happen gradually. So you could be waiting a long time to get involved as well and finally buy that company that is at a good price point. I completely agree that to be an investor rather than a speculator, you have to be investing for the long haul. Otherwise, it is essentially gambling, and that's something we want to avoid. In Benjamin Graham's book, Intelligent Investor, he talks very wisely about the difference between speculating and investing, and being a long-term holder is a key element of that. He also talks about how, which is something I really gel with, which is being a good investor is more about character than IQ, because it's about, sticking to your laurels when the market's going against you or being offside. And I witnessed a lot of value investors struggle recently because value investing was essentially out of favor for the years leading up to the pandemic, which led to a lot of people almost abandon the strategy. And it thankfully came back post-pandemic as everyone realized we needed things like infrastructure, education, basic amenities. So yeah, it requires you to be a very long-term investor and have a very long-term time horizon, which I think a lot of people essentially don't have in this age of crypto and trading in and out of things. So yeah, that's definitely a key element. So yeah, I hope you enjoyed this video on value investing and the strategy that led to Warren Buffett making his millions. I'll just caveat by saying that I am not an equity expert, nor am I giving investment advice by doing this video. That's a key element of what I want to get across. So yeah, I hope you enjoyed this video. Don't forget to check out this one here if you want to hear more from me, and I'll see you in the next video. Thanks.